Hi, Ed Harrison here for Real Vision. I have the distinct pleasure of talking to Daniel Lacalle, who is the chief economist and CIO at Tressis. Daniel, welcome back to Real Vision.
Thank you very much. Thanks for having me, Ed. Always a pleasure.
Yes, definitely. I'm really excited. I was telling you just before we came on, we spoke about 8 months ago, right before this interview. I was reviewing some of the things that we were talking about, but a lot's changed because you and we were talking about the economies as the reopening was happening. And that was 8 months ago. I mean, what happened in the reopening is that the US was looking terrible and Europe was looking better. And you were like, hang on, that's not how it's going to play out over the longer term, even over the medium term. And in fact, you were exactly right. What we're now seeing is a rally in shares in the economy of the United States in particular going forward. The real question is what should we think about this? How do we frame this economically? And how do we invest against it? And that's what I want to talk to you about over the next hour or so that we're going to have this conversation. So frame it for me first. What's happened between now and between when we last spoke and what's happening now?
I think that what we have seen is the difference of how you target stimulus very clearly, very, very clearly. The United States has focused the vast majority of the stimulus plans on preserving the business fabric, on helping families, and on keeping the economy alive. Whilst in Europe, what you have seen is the vast majority of the stimulus plans aimed at preserving and increasing current government spending. Big difference. Big difference, actually. And if we think about it, one of the things that we have seen as well is that the idea that was implemented in Europe that putting together these massive furlough job schemes was going to be the way to both preserve the job market and recover faster has proven to be wrong. The reality is that we look at unemployment in the United States today, it is slightly above 6%. In the Eurozone, it's above 8%, plus almost more than 10 million people in furlough jobs. So I think that what we have seen is a much worse recovery of the employment base. I think that what we have seen is a much more detrimental to the economy response to the second wave of the COVID-19 crisis and the misguided lockdowns. I think in the United States, you've had a much more flexible and at the same time, much more prudent approach to the measures to contain the virus. And obviously the vaccine rollout, we can't forget that. The vaccine rollout has been an absolute success in the United States compared to a very slow, bureaucratic, and again, incorrect rollout in the Eurozone, in the European Union.
So everything you're saying is interesting because when you look at it, it's just a complete reversal of where we were before. With everyone touting the Eurozone and their response to the virus, and the US doing terribly. And actually, the UK was doing relatively poorly too. Now the UK is also...
What we're showing you here on our YouTube channel is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
And their response to the virus, and the US doing terribly. And actually, the UK was doing relatively poorly too. Now the UK is also rolling out the vaccine very well. It seems that their economy is getting back on track well. What do you see going on there?
I think that what is happening in the UK is very similar to the United States, and that's what we discussed in our conversation last time, is that the United States and the UK are much more open, much more flexible economies than the Eurozone one. And so therefore, the idea that the Eurozone was going to recover faster, with all due respect, was almost impossible. You know, and the reality is that it's such a directed economy, and there's so many layers of bureaucracy driving not just the vaccine rollout, which is much slower than in the United Kingdom or in the United States, but the way in which the stimulus plans are being implemented before, fundamentally directed to preserve and increase government spending. Therefore, what happens is that the multiplier effect of the measures that are taken is actually much lower. And obviously that takes into account the very negative decision to implement aggressive lockdowns, then opening, then locking down again, instead of a more flexible and more limited and targeted approach like we have seen, for example, in the United States. So I think that what we're seeing basically is that the economies that have a larger level of flexibility, a larger level of private entrepreneurship as well, driving the small and medium enterprise factor, and in which the government actions have been fundamentally driven to preserve the business fabric, those are recovering faster. And if you actually look at the Eurozone as a total, and then separate by each of the countries, you see that there's a huge difference in the recovery process, as well in the more flexible, more open economies that, like, for example, the Netherlands or Germany itself. No?
You know, before we get into what the implications are for asset allocation, I want to take a step back, because obviously asset allocation, when you're a long-term investor, you're thinking about the long term. To think about this, framing it not just from what's happening now and has happened over the last 8 months, but just a general framework, how we can think about this over a longer period of time. And I'm thinking in particular about the conversation you and I had in July, where we were talking about, from your perspective, a longer term view where we saw weaker growth coming out of each recession. The way that I guess I would frame it is that what we're seeing now is a manifestation of what we've seen before, which is that there's some level of government intervention, less perhaps in the US and the UK, or at least more targeted towards the private sector. And this intervention has morphed from being just a monetary policy intervention, heavy on monetary policy, to monetary and fiscal policy. What you at the time were calling it the everything bailout. Yeah. First of all, is that your view today still? And to the degree that it is, what does it mean for the economies over the longer term?
I think that we've gone from thinking about the bailout of everything to the bailout of anything. For example, we are seeing news today in Europe about governments bailing out companies whose problems have absolutely nothing to do with COVID-19, problems that came from 2018, 17, 16. So that is an important problem. I think that the other important problem is that there is a widespread view of seeing government as the lender of first resort, as the solution of first resort instead of the solution of last resort, which is very negative for in terms of implications for the level of growth that we get once the pandemic is over, but also for productivity growth, which is absolutely critical for the estimates of real wages. And I think that has not changed, actually. If anything, in my opinion, the recovery that we are likely to see once the base effect of the reopening is behind us is likely to be much weaker precisely because of that situation that we just mentioned before, is that there's a constant decision of bailing out or helping the sectors of low productivity. But once the recovery is in full swing, what we are likely to see is a massive increase in taxation on the sectors of high productivity. So if you subsidize low productivity and you tax high productivity, and at the same time, government presents itself as the lender of first resort with a generalized view that that is actually a good thing, then the weakness of the recovery is significantly poorer, is much weaker. So that is one big concern. And I come back to the point of productivity growth, which is, in my opinion, a key factor, because if productivity growth is not just subdued, but actually zero, as we have seen in some economies in the previous recoveries, then real wages don't grow. And if real wages don't grow, then the problems of discontent, the problems of concerns about the situation of an average household in terms of the real disposable income increase. And I think that when we are thinking about a recovery in which one of the predicaments that we hear constantly is that we're going to see a massive boom of consumption once the economy fully reopens, if we don't see real wages going along with it, and if we don't see productivity growth improving, then this the evidence of zombification is not just lower growth, it is a much worse situation for the poorer and the middle class part of the economy.
Yeah, and I think in terms of that's a great framing, and it leaves me thinking about a lot of different things, because ultimately, from a policy perspective, you have to get this right. Let me give you an example that earlier today, I had a tweet out, David Rosenberg, who I speak to often. I was reading one of his latest missives, and he pointed out that the Reserve Bank of Australia's Governor, Philip Lowe, he was actually talking about exactly what you're saying. He said that for inflation to be sustainably within the 2 to 3% target that they have, wages growth, as he calls it, needs to be materially higher than it is currently. And he said the evidence strongly suggests that this isn't going to occur very quickly. He doesn't see it happening until 2024. And his conclusion, therefore, is that we, the central bank, we're going to keep interest rates really low as a result of that. So wage growth not going up, we are going to solve the problem by having incredibly low interest rates. To me, that's a question. Is that really the solution? If so, how? And if not, why not?
Well, obviously, as a central banker, what he is saying is they have two tools: increasing money supply and lowering or increasing interest rates. Those are, in essence, the pillars of the tools that they have. But the problem is that you don't address real wage growth with monetary policy. You address real wage growth by implementing policies from a fiscal perspective that incentivize high productivity. And that is something that governments in general, and it's not a question of this party or another, that governments in general tend not to do, because by definition, a government that wants to keep things as similar as possible to where they are today will inevitably direct the vast majority of the support schemes that fiscal policy gives them to maintain the status quo of the sectors that exist nowadays and subsidize, in many cases, the low productivity sectors. But because the fiscal response is so huge and the deficit spending is so large in the periods of crisis, what happens when the economy recovers is that the fiscal policy turns to detrimental to productivity by continuing the subsidy on low productivity, but massively increasing the taxation on high productivity. So it's a double negative. So the point that many economists are making today is don't make the mistake, and that's my point as well, is don't make the mistake of to try to get a few tens of billions of dollars of extra revenues in a 3 trillion hole. Don't go and massively increase taxation, because that is going to generate a much bigger problem of productivity growth, and with it, real wages. And you don't solve that through legislation by saying, look, we're going to increase wages by law, because it doesn't happen. And more importantly, I come back always to the point, you're hearing me all the time say the word real, because I'm interested in real wages, not in nominal wages, because if you increase inflation through monetary policy like we're seeing today, in which the disinflationary components remain, absolutely they do. But there has been a problem for many years of non-replicable goods and services that are rising much faster than real wages and then headline CPI, education, healthcare, insurance, you name it, fresh food, all of those factors. We need to be aware of the fact that the level of inflation for the worse off in the economy is much higher than that for you and me, or the people that are watching us today, which we all belong to the upper to middle class. No? So the point that I'm trying to make is that lowering interest rates and going further into negative real and nominal interest rates is not what is going to drive real wages higher. What is going to drive real wages higher is if the fiscal policy is targeted more towards the creation of new businesses and to the incentive to increase the percentage of sectors of high productivity, because that is what is going to drive real wages higher, and the percentage of the population that is in the workforce higher as well. One of the concerns right now is this concept of the jobless recovery, isn't it? Is the fact that as we mentioned before, we are still seeing an elevated level, although significant improvement in the United States, but a very concerning level of unemployment and underemployment in the European Union, in which you have the epitome of massive fiscal policies allegedly targeted towards helping the worse off. The best social policy at the end of the day is creating jobs, and creating jobs can only come by not putting the brakes on the high productivity sector, in my opinion.
In all of that, the one thing that stands out for me is when you focus on the real, you're talking about not only about real wages, but real wages as compared to the price level, i.e., there's nominal wage growth. This is how much more money I'm getting. But then, of course, there's the inflation associated with it. And interestingly, up until this point, inflation has been tame, and it's been going down over a secular period of time. Globalization, a lot of different things are responsible for that. But in the regime that we have now, which you described as the everything bailout regime, now becoming the anything bailout, where the government is the lender of first resort, is that the way that inflation moves forward? Is low inflation something that we're going to continue to see?
Well, we will continue to see low headline CPI, Consumer Price Index, low or subdued headline Consumer Price Index. But we must not forget that before COVID-19, there were already problems all over the world of protests in France, in Germany, in Spain, in Chile, in many Latin American economies and some other emerging economies about the rising cost of living. So how do we reconcile a very low headline CPI with increasing protests against the rising cost of living. Again, it comes back to the basket, no? And it comes back to the weight of each of the products in those baskets. If rent, fresh food, education, healthcare, insurance go up faster than real wages, yet technology, leisure, and hospitality come down, headline inflation is obviously going to continue to look subdued, and it will actually see a very big move back to a weak level in the second part of this year after the base effect is gone. However, the sticky part of inflation remains higher than what central banks or governments are thinking about, and that creates the discontent. We saw it, for example, in the inflation figures of the Eurozone. No, we saw the Eurozone headline CPI being very weak, and significantly below the 2% target of the ECB. Absolutely, it was. However, you saw at the same time that fresh food was up 4%, that public services were up 3 to 4%, that things like that are rising faster. That is the problem, in my opinion, is that we need to be a little bit more granular about inflation, particularly from a policy perspective, because it's hurting the people that it's supposed to defend the most. Because on one side, policy continues to be driven towards increasing inflation at any cost. Inflation for those non-replicable and essential goods and services actually is there for the things that we actually want and we actually buy, and the things that we actually buy on a daily basis. If fresh food is up 4% and technology is down 7%, the impact on inflation is very high. However, what do I eat every day? And what do I not buy every day? I don't buy every day a phone or a camera. No, so I think that this is something that central banks need to pay a lot of attention to in the next years as this bailout of anything continues, which it will, because you're likely to see a rising difference and a rising wedge between the people that have access to assets, the people that have access to debt, the people that have access to on their daily basket more of a similarity to the basket that the government uses, and the middle and lower classes. And I think that that's an important factor, particularly, as you very well said before, because it's much more difficult for the middle class to rise up the property ladder or the wealth ladder when you have repression on wealth, and at the same time you have a rising price of housing, of all those essential core goods and services, which negatively affect, what it's basically doing is shrinking the middle class in both sides. On one side, because their inflation is higher than what the government or the central bank perceives, and second, because they basically invest the little that they actually save in deposits that are being consumed by monetary policy.
Yeah, that's not a good outcome. Let me ask you also on inflation, since we're talking about that, about other factors that have been large in terms of thinking about inflation. I'm thinking particularly about China. I'm thinking about demographics, technology, and then finally, just general overcapacity at the end of this particular business cycle because of the pandemic, and the fact that the new normal is going to be very different than the old normal.
Very good point. Those three factors, China as a massive exporting machine of cheaper goods and services, technology and demographics, are disinflationary. Absolutely they are. And I think that when policymakers look at the way in which they think of inflation and the way that they think of target inflation, they should take into account those things. You cannot think of a 2% as a moderate inflation when the challenges that I mentioned before about the basket of that we are using, or that is used officially for CPI, reflects such massive disparities between different types of consumers. But you also cannot think of that any policy in terms of increasing money supply or lowering interest rate is justified simply because inflation is not at 2%, when in reality, considering that we live in open economies in which technology is creating positive disinflation, because disinflation is not negative. Technology disinflation, which is productive and competitive disinflation, is actually very good. The aging of the population and the demographic component are not disinflationary factors that should be addressed via monetary or fiscal policy, simply for a very simple reason, because they have absolutely nothing to do with those. No, they have to do with the fact that we age and we consume in a different perspective, in a different way. And China's competitiveness as an exporter, not only China, but other emerging markets, India, etc. Those are positive disinflationary effects. We are able to acquire more goods and services, and better quality ones, with a higher control of prices. So policymakers need to take those into account, not as negative disinflationary effects. They look at inflation, policymakers, and they say, oh, prices are coming down, that is bad. Well, hold on a second. Is it a competitive, is it an export-led or demographic-led disinflation? Because that is actually good. Or is it a postponement of investment and consumption decisions because of the fear of lowering prices? Because those are two completely different things that have completely different policies that need to be used to address them. No, so I think that basically what I find is that central banks and governments are using the tools of a 19th century economy for a 21st century economy, is that they are thinking of inflation and deflation as one only thing. I don't see any problem in the fact that this camera that I'm looking at is 75% cheaper than it was a year ago. There is nothing negative about that. But what we cannot say is that this camera is 75% cheaper. I don't know if it is, but imagine that it is. Okay, it's 75% cheaper, and the fresh food that my children eat every day is up 7%, and I'm not addressing the second, and I'm worried about the first. So we need to be more granular about inflation, because if we address with the same policies of the 20th century, a 21st century economy, what we are doing is actually not through evil, but what they're doing is generating a second consequence that is even more negative, that is policy-driven inequality, which is what I mentioned before, is that the poor and the middle class are unable to climb up, and at the same time, the government is thinking that there's no inflation. Of course there is. Talk to anybody in the world. If there is inflation on the things, on the goods and services that they buy on a daily basis. The fact that hotels are down is irrelevant, because I go to a hotel, if I go on holidays or on business, a certain period of time, but once or twice or a month, depends on my schedule. But it's not the same as what I do on a daily basis. I think that that's what we need to do, because if not, the risk of discontent that we have seen in so many countries here in the Eurozone. I come back to the protests that we had in France day after day after day after day against the rising cost of living. So those are important factors, in my opinion.
Yeah, and if you think of it as inflation in the things that you need and deflation in the things that you want, obviously, if you have better means to deal with inflation, then overall you're in a better position. And so the people who are getting the inflation and who have less to deal with that inflation and the things that they need, they're going to be in a worse off situation. And that leads to political unrest, as you were saying. Yeah, now, there's another thing that you were saying that I thought was interesting when you were bifurcating between the good inflation and the bad inflation. One of the things about the bad inflation that you were talking about is I got a sense of, debt deflation, i.e. we're over our skis in terms of the amount of debt that we have, that, the economy is not doing incredibly well. Immediately, it made me think about our interview last time and your thought about once we have this, people are talking about it as this pent up demand. Once that's over, what kind of economy are we going to go back to? What kind of dynamics in terms of that bad inflation are we going to avoid or actually have?
In my personal opinion, and sorry to be a little bit pessimistic here, we're going back and massively to the concept of secular stagnation. No? And I come back to the point, you think we're going to see this recovery of consumption, we're going to see the recovery of the economy once the vaccine rollout is completed and all of this, but the IMF, the OECD, the ECB, all of the international bodies are telling governments continue to spend because they fear the outcome of the previous crisis. They fear that if they don't continue spending aggressively and increasing the deficits in the recovery, then we're going to have a 2011 type of European crisis, which has nothing to do, by the way, with austerity, has everything to do with bad government spending. But the point that I'm trying to make is that we need to go back to 2019 to understand where we're going, because we're going there accelerating. In 2019 and 2018 already, the signals of stagnation, debt-driven stagnation, were very evident. Remember that in the fourth quarter of 2019, Germany was close to recession. Italy was growing at 0%, France was growing at 0%, and the US economy was starting to slow down as well. So I think that what we need to understand is that once we get out of the 2020, 2021 response to the COVID-19 crisis, and the mistake of putting all of the structural challenges of the economy under the COVID-19 umbrella, is that we're going at 300 miles per hour to that same place that we were heading into in 2018. Which is much lower growth, much lower productivity growth, much higher debt. And this is the constant problem of policy versus what it tries to achieve. We know by now, after decades of different recoveries, that out of each recovery, the multiplier effect of government spending on the economy is lower and in some cases negative, okay? So the more we spend on fiscal policy, on increasing the imbalances created by current government spending, the weaker the outcome is going to be. And unfortunately, I think that we tend to forget, we tend to talk a lot about the recovery and the new normal, which is fine because we're looking forward, without remembering that in 2019 and 2018, the signals of weakening growth were already there. So the point of debt deflation that you're mentioning, here's the problem I have with the way it's addressed. Debt is rising, government debt is much higher, and they're trying to generate inflation in order to reduce the debt in real terms via increase in prices. Okay, we all understand that. What is the problem? The problem is that when your response is to increase deficits by massively pumping up current government spending, you don't reduce debt in real terms either. That is my problem. My problem is that the inflationary policy does not achieve the level of inflation that would reduce the debt that has been accumulated, yet the fiscal policy and the deficit spending, which is fundamentally driven towards current government spending, generates even more debt even when there is inflation. And that is why we're seeing such a problem, for example, right now in some emerging economies, is that despite the fact that inflation is rising, none of the indebted sectors get out of the debt burden because the constant increase in current spending outweighs the improvement of the debt via inflation or the improvement of fiscal revenues.
Yeah, that's not a good picture. And I think it's a great segue into thinking about asset allocation. Because, the question that comes to mind is if that is the eventual outcome and I'm investing for the medium to long term, then I want to know what I need to do in order to deal with that situation. So let's talk about where we are right now from an asset perspective. We're in, what you were talking about, the everything bailout. I'm thinking of it in terms of the everything asset price inflation, all sectors going up, whether they're good or bad, whether they're low growth or high growth sectors, everything's going up. How long can this go on? And what do I do in order to protect myself if it can't go on for that much longer?
Mm-hmm. I always say that we have to think about this as if you were surfing, no? Mm-hmm. You need to understand that you're riding a wave, okay? And you cannot be either at the bottom of the wave because then you make no money, okay? And you cannot be at the top of the wave because you're going to crash. So my point is the following, is that when you have such level of correlation, which is insane, absolutely insane. And by the way, policymakers should pay more attention to the risk of such level of correlation between assets. But when you have that level of correlation, we need to understand three things, in my opinion. First, economic cycles are shorter and more abrupt each time, okay? So many times we talk about a diversified portfolio, and we're not diversified at all because everything is so correlated. So in reality, when you look at many of our portfolios and we think I'm very diversified, and in reality, you only have one bet. And that is what most people have in their portfolios, which is weaker dollar. That's your pillar of the portfolio. You're long emerging markets, you're long equities, you're long emerging economies and Eurozone bonds, and you are exposed to the so-called value sectors. Thank you very much. You are short the dollar. Okay, but so then you have to be very aware of how dangerous that is. No, and the point that I'm trying to make is that from the asset allocation perspective, if you're looking at the mid to long term, you need to understand that this process of secular stagnation that I mentioned erodes the value of the so-called value sectors. They become less and less valuable because those sectors, those companies that are valued from a position of the rent that they get from just being there, reduce their value and their margins and their profits. Point that I think that you need to take is that when you have an environment like we had between October and the end of the year, in which the so-called value sectors start to recover, you reduce exposure to them, like you were surfing. And when you see that sovereign, almost insolvent bonds go significantly higher in price, you reduce exposure to them. And you stand basically with a portfolio in which you have exposure to technology, exposure to the stocks that are benefited from the aging of the population that we mentioned before, the technology revolution, and the increase of competitiveness globally from more exports from China, et cetera, the sectors that benefit from those secular trends, sustainability, technology, and demographics. and you avoid the ones that are optically cheap or the ones that are too expensive compared to with their solvency ratios.
Yeah, so in terms of the reflation trade that's been going on now, it seems a lot of the reflation trade has been a rotation out of the sectors that had benefited during the previous bout of secular stagnation, exactly the companies that you were talking about, but toward the value stocks, and in particular, obviously, energy and financial services. I want you to talk to me about that, but also the simultaneous move into what I would call the bubblicious stocks. So it's almost like a barbell between, okay, here are these stocks that are benefiting from the new wave forward. We're going to go into the supercharged version, but much more risky version of those. And we're also going to, move into these undervalued value plays. And that's what I'm going to do during this whole reflation period. How good of a scheme is that? How long can you make that trade before you get run over by the change because of secular stagnation?
Very good point. I think that you have a window of opportunity, more or less, in my opinion, until May of this year. The reason why is because all of those reflationary pressures and the base effect from 2020 still help you, okay? And most of the analysis that you're going to receive from investment banks, from brokers, is going to continue to be focused not on the earnings today or in the margins today, but on expectations that are completely impossible. Okay, so I think that you have basically, I don't know, but I think you have more or less the first half of 2021 to continue to bet on the mirage of the recovery of the value stocks. Okay, once that happens, you start to get the base effect goes negative. Remember this, because people are seeing, between March and May, the base effect in inflation, in growth, in so many things, in sales for many of these sectors, is going to be phenomenal. It's going to look awesome. Think how it's going to look in September relative to September last year. And I think that is an important factor, is that you have to be tactical about the reflation trade without forgetting the disinflationary pressures that I mentioned before, and without forgetting that there's a very wide difference and a widening difference between the headline inflation and the one that we look at for our investments and for policy, and the one that consumers perceive, because the latter affects the sales and the margins of the so-called value sectors.
Yeah, and now in terms of those value sectors, when you look at value in general, let's look at Europe as an example. You're looking at old line industrials, you're looking at cyclical stocks, you're looking at financial services, and then if you move to the United States, you're also looking at the energy sector in particular. Of those sectors, which ones are the worst off in the post-May period, and which ones are potentially a better play for the post-May period?
Industrials are better. Oil and financials are worse. The reason why is because the energy sector in particular should never be included in the concept of value. A sector that generated an 11% return on capital employed at $11 a barrel when I was working in it, and generated a 10% return on invested capital at $130 a barrel a few years ago, should never be included as a value sector, because it's optically cheap in terms of PE or in terms of the multiples until you make the valuation relative to which returns they make relative to cost of capital on a normalized environment. So that is one that is very, very challenging, and that you can play tactically. And I think that most people actually do. I think that investors in general have become aware of the fallacy of the long-term investment in the energy sector. Financials, particularly in Europe. The problem of the financial sector is not just inflation, it's policy. Mm-hmm. And it's negative real and nominal rate policy and regulation, in the case of Europe in particular. So those two things erode their net income margin and make their core capital very small, even when they increase it. They need to constantly increase their core capital in order to address the non-performing loan issue, which was already 900 billion before COVID-19. And you also have to understand that things that you, for example, talk about and have written in your Twitter account, etc., and all these things that we're talking about, the digital dollar, the digital euro, those are bad for banks. That's destruction of the bank business. Let's be fairly honest. The policy of central banks and governments is not going towards improving the profitability of banks. It's going towards reducing it and zombifying them. Therefore, the market gives you very good opportunities to buy and sell out of them, but not consider them value plays, because you cannot consider that a stock is a value stock because the multiples at which it is trading right now look optically cheap when the return that it generates relative to its cost of capital is very low or negative. No, so I think that those elements we need to take into account. So I would take away from the value concept but I would think about the industrial sector as an important one, where there can be a significantly interesting opportunities. The situation that is going on with sustainability that I mentioned before is a good one for the utility sector in the long term. Secular stagnation as well. So there are pockets of value in the value segment.
When you talk about energy, I want to hone in on this a little bit. There are the integrated energy companies. There are up and downstream. And I know since you were in this field, you know all about that. And then there's midstream. I know that Warren Buffett, he likes the midstream because that has consistent cash flows. Are there pockets within that, both up and downstream and midstream, that are better than other sectors? And especially when you look at the integrated oil giants, which comprise the full panoply of assets.
Well, I agree with Mr. Buffett there that midstream is an attractive part because it's very basically almost like a bond, isn't it? No, so I agree with that. Now, the problem of the integrated sector goes back many years ago, and we need to think more around the beginning of the 2000s. The integrated energy sector used to be exploration and production is a cyclical business in which you invest in the low part of the cycle and you reap the cash in the high part of the cycle, and you churn the asset base by buying and selling assets. It was basically an asset management business. The refining business was counter-cyclical. So when the exploration and production didn't work, you got the cash flows from refining and marketing. And that generated an almost stable environment, and you added the gas and power. You basically had something that was used to be ages ago an almost byproduct of oil production, natural gas. You were actually generating profits out of gas and electricity. So all of that generated sort of an integrated view that would allow you to generate positive returns in the different parts of the cycle. When did it all go wrong? When oil companies started to talk about the oil price. I remember when Exxon used to say, I don't care what oil price there is, what we need to do is to be profitable at whatever the oil price is. And then they started to be pro-cyclical instead of anti-cyclical. So they started to invest aggressively in exploration and production when oil prices were rising. They started to invest aggressively in refining when overcapacity in refining was already there and refining margins were going up. So instead of having investments that have been made at the bottom of the cycle and that reap high returns at the peak of the cycle, they started to have investments that were made at the peak of the cycle that needed a higher peak of the cycle. And the entire concept of what an integrated oil company had to be disappeared, because they're doing the opposite of what they do. And now, for example, think about it. When are they investing in renewables? Now. Right. They're investing in renewables now. Are you crazy? You know, so now what they should be investing is in exploration. But no, when did this change? It changed when the industry, and I'm sorry to go, went from being run by engineers to being run by lawyers. And it's been a disaster. And the value destruction of the integrated oil and gas sector is so phenomenal that it's very difficult to justify in any way. So the problem that I see is to consider that is value, because yes, you know, part of that, of their assets generate value, okay, but there's an interesting factor here. Why are they selling the assets that are most valuable at the weakest part of the cycle and buying into the most aggressive valuation part of the cycle, the renewable sector now? You see, they're doing the opposite of what they should do. And that, if you look at it now or 10 years ago or 10 years after, is simply value destruction, no? It's the same way that when banks in Europe decided to expand out of the European Union to places where inflation was very high, because what they were doing was buy at peak valuations, alleged returns that they were only going to see diminish. And obviously that value destruction is very important. So my point is, when you look at these sectors, look at the stocks that have the least, you know, for diversification, you already have your portfolio. You don't need a company to diversify for you. And so look for actually companies that are focused on something. You want to bet on higher oil prices, buy exploration stocks. If you want to bet on increasing capital expenditure in the oil or in the energy sector, buy service stocks. If you want to bet on refining margins, buy refining stocks. But integrated, I'm sorry, the ship sailed many years ago.
Yeah, very good insight into that sector. And I wish we could go on about that because I have a lot more questions. Maybe that's for the next time. I have some other questions for you. I mean, obviously, the big overhang of the dollar is there. We're going to get to that in a second. But Japan, we haven't talked about Japan at all. And I'm thinking about Japan because a lot of the macro issues that we're talking about, they saw them first. Yeah. And the narrative I hear now is that Japan is, to a degree, on the other side of the problem. They still have the debt overhang, 240% of GDP, government debt. But how are you looking at Japan as a medium to long-term play from an equities perspective? From
an equities perspective, you have a significant change in the corporate governance and in the structure of the Japanese companies. Remember, the Japanese companies used to be part of that value trap that we were mentioning a couple of minutes ago. Why? Because they were huge conglomerates that basically used the returns of the good businesses to finance very bad businesses. No? So there was a constant value destruction. A lot of that has changed. And I think that is an important factor to acknowledge out of the Nikkei stocks. A lot of things have changed as well in terms of addressing total shareholder return. I think that, however, Nikkei stocks, you need to look at them precisely because they're behind that process that you just mentioned. You need to look at them from a more cyclical standpoint, is that they are more cyclical than they used to be. They used to be sort of boring and almost stable returns, and you just basically bought and sold them according to what the BOJ, the Bank of Japan, would do, wouldn't you? But I think that right now you have to acknowledge at least that they have, when they're in an uptrend, they have between 3 to 4 quarters of earnings and margins growth and then weakness. Because what they cannot change is the demographic factor of Japan. Japan is not only aging, it's also diminishing population, no? And their businesses abroad, again, are very dependent on the cycle, no? So I think that as such, they're a good play on that. But I don't think you would buy them for the long term, in my opinion. I think that, I still continue to believe that you have to look more at US companies for long-term investment, and the Japanese companies look at them from a cyclical perspective. I don't think that Japan is going to come out of this crisis growing faster than the United States, or addressing its problem of productivity and growth, again, because of the demographic and because of the overcapacity components that we mentioned. But I do think that there's a structural change in many of the Japanese companies that allow you to invest more comfortably than in the past, in which you were basically subject to companies that had a strategy that was almost dictated by government.
Yeah, when you talk about Japan versus the United States, that is a great segue into the whole dollar conversation, because when we were talking about asset allocation earlier, you were saying basically, these correlations are all there. You're really betting on a low dollar. When you are going into emerging markets, when you're going into Europe, et cetera, what you're basically saying is the dollar's weak. But when you think about the United States outperforming, to me, that's not a scenario in which the dollar is weak. And we seem to have hit a bottom around 89.90 on the dollar index, and the dollar is now in the process of moving up. How do you see that happening over the medium to long term, and what does that mean in terms of your own thinking about asset allocation?
I think that one of the interesting things that we're living right now is something that very few people would have imagined, in my opinion, me included, is that we see a radical bounce in commodity prices, and the countries that export those commodities are seeing their currency devalue relative to the dollar. You've seen the Brazil real, Mexican peso, et cetera, et cetera, et cetera. So many of those currencies. What does that tell us? It tells us that the dollar is not strengthening or bouncing from the 89, 90 level to the 92 dollar index that it is right now, based on the fact that the Federal Reserve is undertaking a more hawkish policy. It is strengthening because the policies of the rest of the central banks are much more aggressive than that of the United States. And as such, what it tells us is that what we're living basically is a fiat debasement environment, because the dollar is strengthening because everybody else is weakening, not because the Federal Reserve is undertaking policies to strengthen the purchasing power of the dollar. Actually, probably the opposite, isn't it? So I think that is something that I find very interesting. And I think that it will play out into the second part of the year, because it also played out, if you remember, in QE1, QE2. If you remember when the Obama administration came and there was a huge concerted consensus call of weak dollar, no matter what. And what we saw was that once that expectation was followed by much more aggressive policies from the rest of the central banks, but without what the Fed always does, which is to pay attention to the secondary demand of dollars. The Federal Reserve is the only central bank in the world that looks at the global demand for US dollars when thinking about monetary policy. Everybody else just prints. And therefore, the fact that we saw that massive increase in in the bet against the dollar. At the same time as we saw an increase in debt denominated in US dollars from emerging markets, you have the Hoover effect. You have a Hoover effect in which the dollar it's not going to strengthen massively, but it's going to remain in that range in which it was for years, no? Between 90 to 95, 97, maybe gets to 100 DXY. Not bad going from 90 to 100. In any case, we tend to forget what percentages are. But it's that range where it moves that is basically telling you that the rest of central banks in the world are conducting the same aggressive monetary policy of the Federal Reserve, even faster. Remember that the Central Bank of Europe has today an $8.6 trillion balance sheet, 62% of the GDP of the Eurozone versus the Fed's 35-36%. No? So I think that the point is the dollar can only strengthen as long as everybody else does the same more aggressively, but without paying attention to the global demand for their domestic currency.
So, the last thing from an investing perspective, as a result of what you're saying, goes to alternatives to fiat. That is gold, silver, Bitcoin in particular. Last time we spoke, we talked about Bitcoin being an asset that's moving potentially towards more of a currency alternative. And I think that the way that you described it is that when we think about fiat and alternatives to fiat, we've seen this play out in the past. We never know which alternatives come good at the end. So you're betting on horses that you don't know whether or not they're going to win the game. But also then there's gold and silver. Talk to me about where you see them now, especially with gold and silver not doing well, but Bitcoin doing relatively well in the recent trading days.
Yeah. The first thing about gold and silver is that if you look at the supply-demand scenario relative to the price in the traded markets, they're clearly looking significantly more attractive. And I think that the point in gold and silver is that right now they underperform, and rightly so, because of very optimistic expectations of recovery and very optimistic expectations of mild but rising inflation and continued sort of almost concerted and synchronized growth. Remember the concept of synchronized growth. So once that fades, that's when they start to come back. And usually what the market gives you is opportunities like this to add to some gold and silver, which help you as a protector of the portfolio when the market starts to realize that the situation is not as rosy as we expect for the global economy. Also because the more that central banks increase their balance sheet, they're going to buy more gold. That's unquestionable. They will buy more gold. They might not be doing it today, but they are doing it on a yearly basis. So I think that right now there might continue to be underperforming. They might, for those reasons, optimistic approach, the global wave of reflation, etc. But good opportunity to buy something so that once the tide comes back, they start to protect. Cryptocurrencies are extremely procyclical. Cryptocurrencies, we're all talking about them right now a lot. Why? Because they're going up. And the reason why they're going up is because everything else is going up. But we need to understand that they're extremely volatile, and that's fine. I think that what we have learned is that their staying power, particularly Bitcoin's staying power as an alternative to fiat, has been significantly more strong than what many critics expected. And I think that in order to be money, they have to be three things. They have to be a unit of measure, a reserve of value, and a widely accepted means of payment. Well, two of those they already are starting to fulfill. But we cannot forget the risk of regulation, intervention, legal and regulatory threats, which we have read all over the place. Central banks don't like competition in creation of money. And we need to be aware of their volatility. When you have something that has very limited supply, think about it as a small cap stock. When you have something that has very limited supply and you have 1, 2 very large buyers leading the price up, the price can come down very quickly. No, but the point that I'm trying to get to is that Bitcoin by now is almost, I would say, 60% of the way to being a valid currency. And if we talked about not only last year, but a few years ago, it was very, very far away. And I think that is probably unstoppable. And again, I come back to the point that you mentioned in the question is, hold on, because there's lots of cryptocurrencies, and we need to understand that the majority of them will simply disappear, that some of them will thrive, but many will disappear. So volatile, we need to be aware of the risk of the disappearance of many of them, but the reality that we cannot even question is that they are gradually becoming money, particularly for the citizens in countries in which, you and I were talking from the perspective of two currencies, the euro and the US dollar, which are relatively stable and relatively safe. Think of the citizens in Argentina, in Brazil, in Iran, in Sudan, in so many countries, or Nigeria, where they see that the reality of their domestic currency is only one way, which is down. Therefore, cryptocurrencies look a lot less volatile and a lot less risky than the way that we might perceive them in the United States or in the UK.
Very good point. I'm glad to end that on that note, Daniel. As always, it's been a pleasure. We talked about different things. We didn't get a whole lot to the political situation in the Eurozone. That's still something I want to talk to you about, and also a little bit more about oil and commodities. So maybe in the next time that we have a conversation.
Always a pleasure. It's been a great chat. Always great to follow you and to chat with you. It's been very, very good. Thank you very much.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.